Hello students, today's session is very important. This is regarding the methods of measuring national income, methods of estimation of national income. This is very important because I said very important, tremendously important, because this is such a chapter from which you are going to get a numerical sum. Compulsorily guaranteed that you will get a numerical sum. But in order to solve that numerical sum correctly, successfully, you need to know the methods very well. And mere baat mano, you believe me, it's not at all difficult. It's not at all difficult. It's easy. If you know the methods, if you know the steps of the methods, it becomes very easy for anyone to solve the numerical sums. If anybody says that it's difficult, I don't believe it. It's very easy. So let's start. The three methods of measuring national income. The first method is the net output method, or product method, or production method, or value added method. Now in this value added method, firstly, what is value added? What is the meaning of value added? Value added is equal to value of the final output minus value of intermediate goods used. Or you can say value of the final output minus value of the intermediate consumption. That is the value added. Then, in the value added method, the first step is the total value of final output produced in primary sector, secondary sector and tertiary sector will have to be taken together. That means value of output of the primary sector plus value of output of the secondary sector plus value of the output of the tertiary sector. These three are to be added. So we get the total value of the final output in the whole economy minus, so subtracting from that, minus value of intermediate goods used, value of intermediate consumption of the primary sector, secondary sector and tertiary sector. Value of intermediate goods or intermediate consumption of the primary sector, secondary sector and tertiary sector. That means the whole economy. By this we get the gross value added in the whole economy, gross value added at market price, or GDP MP. Gross value added at market price, or GDP MP. Sorry. Now, after we get in the first step gross value added at market price or GDP MP, the next step is gross value added at market price or GDP MP minus depreciation or consumption of fixed capital. As you know, depreciation is also called consumption of fixed capital. So gross value added at market price or GDP MP minus depreciation or consumption of fixed capital, what we get? NDP MP. Net value added at market price, or NDP MP. Now the next step, after we get NDP MP, net value added at market price, the next step is NDP MP or net value added at market price plus net factor income from abroad. Net factor income from abroad, NFIA. We get NNPMP, net national product at market price. Now this net national product at market price is the second last step. Because what is national income? National income is NNPFC, net national product at factor cost. Once we get in the second last step, NNPMP, what would be the next step or the last step? NNPMP, net national product at market price minus net indirect taxes is equal to NNPFC or national income. Now you all know that net indirect taxes is equal to what? Indirect taxes minus subsidies. Thus I make a summary now of the whole method, the entire method. The first step, total value of final output produced in primary sector plus secondary sector plus tertiary sector. That means in the whole economy, minus total value of intermediate consumption or value of intermediate goods used in primary sector, secondary sector and tertiary sector, all taken together, that means added. By this we get gross value added, GVA, gross value added at market price, GVA MP or GDP MP. Now this is the first step. Next step, GVA MP or GDP MP minus depreciation or consumption of fixed capital, we get NDP MP, gross to net, NDP MP, net domestic product at market price, net domestic product at market price. Then after we get NDP MP, the next step, NDP MP, net domestic product at market price, plus NFIA, net factory income from abroad, we get NNPMP, net national product at market price. And then the last step, NNPMP, net national product at market price, minus net indirect taxes, that is indirect taxes minus subsidies, indirect taxes minus subsidies, we get NNPFC or national income. So this is the value added method. These are the steps. It's very, very easy. Only you have to remember these steps in the value added method or net output method or product method or production method. Now, regarding the value added method, there are some precautions. There are some precautions which you need to remember, which you need to know, you need to remember. What are those precautions? Like, value of the goods produced for self-consumption, like value of the crops or goods, products which are produced by the farmers for self-consumption, should be included in the calculation of national income, because these goods are not sold in the market, so they do not have any market price, but their value is to be estimated or imputed, because the reason is, if the farmer would not have produced these, he would have bought it from the market. That is why this is to be included. Next, own account production of fixed assets such as residential buildings by households and factory buildings by entrepreneurs should be included. Again, the same type of reason, that own account production of the fixed assets, very much similar reason. That means if the person, the household member, the person who has made that building, who has made that house in which he will be staying, he would have stayed somewhere else. He would have stayed somewhere else, and then he would have to pay money for that. Then instead of that, he has made his own house by his own money. So own account production of fixed assets are to be included. Next, imputed rent of self-occupied houses we should include. That should be included. Imputed rent, estimated imputed rent of self-occupied houses should be included, because again, this the rent which he is paying, imputed rent, imputed, because the person is staying in his own house, but he could have given the house for rent, on rent, and then the tenant would have paid to him. So that amount, the rent calculated, estimated, imputed, would be taken into account in the consideration of national income accounting. Now, services of housewives such as cooking, meals and looking after the children and other things, other household activities which the housewives do. So many activities the housewives do. The housewives' activities, the services of the housewives should not be included. Should not be included, should be excluded. Because those the housewives are not paid. They are not paid. And that is why the services are unpaid, and that is why no question of taking into consideration the services of the housewives. Now, sale and purchase of existing commodities or second-hand goods are not to be taken into account, because these transactions have not contributed anything to the flow of national income or goods and services in the current year. Second-hand goods. Now, these second-hand goods, because old, these are not adding anything to the values of the goods and services in the current year. Similarly, the last precaution is sale and purchase of bonds and shares are to be excluded also from the national income calculation because they only reflect the transfer of an asset. It is not an addition to the national income, it is just the transfer of an asset. Fine? So these are the precautions which are to be taken while calculating national income from value added method. Now this value added method and its precautions, this is very important. Now when the question is asked, you can be given, in ISC exam they often give, may not be national income to be determined. Maybe they will give the question from the following data by using net output method or by using value added method, calculate NDPMP or calculate net value added or calculate NNPMP, or it can be national income. As I have told you stepwise, step after step, so you will remember, you will learn, split it into parts, into steps, one after the other. Then in every step what you are finding out, that you can remember. So if you remember at once one step, that may be difficult. So stepwise, step after step you remember, then it will be easy. If they do not ask you to find out national income, if they ask you to find out NNPMP or NDPMP, something like that, then also it becomes easy for you to remember. Well, now I come to the income method of calculating, estimating national income. In income method, the basic steps in the first step, what we take into consideration. Compensation of employees. I would tell you the details about the components of compensation of employees. So compensation of employees plus operating surplus plus mixed income of self-employed. These three are added in the first step. Compensation of employees plus operating surplus plus mixed income of self-employed. These three added. By adding these three, we get in DPFC, net domestic product at factor cost, which is domestic factor income, or you can say domestic income. So in the first step, we get compensation of employees plus operating surplus plus mixed income self-employed, we get in DPFC. And one more step, just one more step, in DPFC, net domestic product at factor cost or domestic factor income or domestic income plus. In DPFC, we have to arrive at NNPFC. Then what is the last step? In DPFC plus NFIA, net factor income from abroad. So these two steps only. First step, compensation of employees plus operating surplus plus mixed income of self-employed or simply mixed income is equal to NDPFC or domestic factor income or domestic income. Then the last step is this NDPFC plus NFIA, net factor income from abroad, is equal to NNPFC or national income. Don't worry, now I'll go into details. First, compensation of employees. That means labor's income earning. The laborers, they work for the organizations, companies, industries, different organizations. Against their work, in return of their work, they are compensated by the employers. So that is compensation of employees. Then what are the components of compensation of employees? Minded, this very question, what are the components of compensation of employees? This is also a very, very vital, very important question which can come because this question came in the past. What are the components of compensation of employees? This question came. Now, the components are, first component is basic salaries and wages in cash. Salaries and wages in cash. Now apart from that, salaries and wages, supplementary labor income. Supplementary labor income. Now see, basic salaries and wages, that is in cash. Then that includes bonus, commission, DNS allowance, house rent allowance, all these. Then we come to supplementary labor income in the form of employers' contribution towards social security schemes for employees such as PF, Provident Fund. Now in this respect, I would tell you something. Just to confuse the students, in the examination question paper, in the question of the numerical sum of finding out national income using income method, in the entries, it can be given employers' contribution to social security scheme and also employees' contribution to social security, that can also be given. Please do remember that you have to take only employers' contribution to social security, not the employees' one, because here we are concerned with compensation of the employees by the employers. So we have to take into consideration only the compensation made by the employer to the employees. So employers' contribution to social security schemes like Provident Fund, group insurance, gratuity, these. Now these can be considered as retirement benefits. After retirement, the workers, they get this. Now next is payments to the employees in kind, like rent-free accommodation, free medical facilities, free or subsidized food, free educational facilities, etc. In many companies, in many organizations, they give free or subsidized food. In some companies, they give free medical facilities. In some companies and organizations, they provide free housing or free rent-free accommodation. Then these are the payments to the employees by the employers in kind. Okay. So this is about the compensation employees components, compensation of the employees components. Now we come to operating surplus. Operating surplus. Operating surplus is defined as the income earned from capital, assets and entrepreneurship. Capital, control over the capital and assets and entrepreneurship. From these, the income earning is termed as operating surplus. Then, what are the components of operating surplus? What are included? See, operating surplus includes or involves rent, interest, profits, and if royalty is given in the questions entries, you have to take a royalty also. So, rent plus profits plus interest, or rent plus interest plus profits plus royalty. By the way, here one thing. In some questions, they do not give profits as such. They give 3 separate individual entries. Why and what those are, let me tell you. The private companies, when they earn the profits, after earning the profits, from their profits, firstly they pay corporation tax or corporate tax to the government. And that is paid out of the profits. From the profits they pay. Then from the profits they pay dividends to the shareholders. Dividends are also paid from the profits. And then after paying the corporation tax and the dividends, that part of the profits which is left over with the company, that is undistributed profits. Thus, corporate tax or corporation tax plus dividends plus undistributed profits is equal to profits. Now, to confuse the students, sometimes they give a redundant data in the question of the numerical sum where you have to use the income method. Profits is given, in rent is given, interest is given, profits is also given. And in addition to profits entry, they have also given dividends. Here, remember, you don't have to take that dividends because dividends is already included in the profits. That is why you don't have to take into consideration that dividends, because profits is given. Suppose if profits is not given, dividends given, undistributed profits given, and corporation tax is given, then you are going to add these three in order to get the profits. Fine. So this is about the operating surplus. So operating surplus is equal to rent plus interest plus profits plus royalty if royalty is given. Now what is mixed income self-employed? The self-employed people, the people who start their own small business and they do everything of their own, providing the money capital by their own, providing the labor effort by their own, managing everything of the business by themselves as managers or entrepreneurs, acquiring the land or buying the land by himself, by the person himself or herself. So everything is done in the business, everything is done by the person. Then this self-employed person provides everything, does everything in the business. Therefore, the income earning of the person, of that self-employed person, is a mixed bag of income. That is why it's called mixed income of self-employed. So, the income method step, the first step is compensation of employees plus operating surplus plus mixed income self-employed is equal to what? Is equal to NDPFC, net domestic product at factor cost. That is domestic factor income or domestic income. And the last step, as you know, in DPFC plus net factor income abroad is equal to NNPFC or national income. By the way, in the question, they may tell you to find out domestic income. Then, if the question is find out domestic income, don't commit the mistake of finding out national income. Only the first step, compensation of employees plus operating surplus plus mixed income self-employed, what you get is the domestic factor income or domestic income, that is NDPFC. Fine. So these are the steps in the calculation or estimation of national income by income method. Now we come to the precautions. The precautions which are to be undertaken while calculating national income, estimating national income by using income method. All transfer incomes, unilateral transfer incomes like old age pension, unemployment relief, unemployment allowance, scholarships to the students, assistance given to the government and other agencies to meet exigencies like flood or drought, something like that. All these type of transfer incomes are not to be taken into account. These are not to be taken into account because these are received by the people without rendering any productive activity, any productive service. That is one. Next, illegal incomes. Illegal incomes like income of the smugglers, like drug traders, like robbers and gamblers. These are not to be taken into account because these are illegal. The name signifies it's illegal. Then interest on national debt. Interest on national debt is excluded from national income because it is treated as transfer income, assuming that the government borrowings are used for consumption purposes. So this may be a question. This is a very vital question. Nowadays in ISC they give this question. Like 4 statements are given and you are asked, the students are asked, state with reason whether the following will be taken into consideration, in the calculation of national income. With reason you have to state yes and then the reason, no and then the reason, like that. Okay, now the next one, interest on loans taken by any person to meet consumption expenditure is also not included. Interest on the loans taken to meet consumption expenditure is excluded from national income since it is a non-factor income. Non-factor income. No factor service provided. Next, money income received from the sale of second-hand goods. Again, second-hand goods. Because like second-hand goods, second-hand shares, bonds, all these. These are excluded from national income because they do not contribute anything to the current flow of goods and services, not in the current year. These are just reflects the transfer of ownership. Next, private transfer payments such as pocket money received by children from their parents, something like that, is not to be taken, is excluded from national income accounting. Then windfall gains like prize money won in a lottery or in a contest should not be included, should be excluded, because these do not contribute to the current flow of goods and services. Then taxes like wealth tax, death duties, gift tax, etc. are paid not out of the current income but out of the past savings, and that is why these should not be regarded as a part of national income, should not be taken into consideration. Next, income tax. Income tax should be included only if the income, it is given that income tax is taken at source, deducted at source. If the income tax is deducted at source, then it is to be taken into account because deducted at source, income tax is deducted and then the income is given to the employee. Now, if the income taxes are paid by the individuals themselves out of their wages and salaries, income tax should not be counted now in that case, right? So these are the precautions which you must remember. In case of income method, these are the precautions. So this is all about income method. Now the next one I'll follow with expenditure method. Okay, let's start with expenditure method now. This is the last one. In expenditure method, the first step is, you can remember like an equation that is easy to remember. C plus I plus G plus X minus M. That's a basic step now I'm telling. C plus I plus G plus X minus M is equal to GDP MP. Now what is C, what is I, what is G, what is X minus M? C denotes private final consumption expenditure. Private final consumption expenditure done by the households for consumption purpose. I denotes gross domestic capital formation. Gross domestic capital formation, that means the investment expenditure. That is investment expenditure. Gross domestic capital formation. Now this gross domestic capital formation or the investment, it can consist of what things? Gross fixed business investment. It can be inventory investment, that means the change in stock, change in inventories of the firms which are in the warehouses. That is there. And then expenditure, investment made on residential investment. So these are components, the constituents of investment expenditure, or we can say gross domestic capital formation. Third component in the formula in the first step is G, which is government final consumption expenditure, or simply you can remember as government expenditure. Government final consumption expenditure or government expenditure, because government incurs expenditure on various purposes, and then that is also expenditure made by the government to buy various goods and services which are required by the government for their activities, and these also lead to income earning by many people. And the last one, the fourth component, is X minus M, that is net exports. X minus M is net exports, that is exports minus imports. Exports minus imports, that is net exports. So this is the first step, C plus I plus G plus X minus M. You remember that I have told the full forms also. Private final consumption expenditure plus gross domestic capital formation plus, that is gross investment expenditure, plus government final consumption expenditure plus net exports is equal to GDP MP. As we are considering gross domestic capital formation, so in this step we get gross domestic product at market price, GDP MP. By the way, if in the entries, if in the given data change in stock is given, then you are going to add that change in stock in the first step itself. And then it will be C plus I plus G plus X minus M plus change in stock is equal to same thing, GDP MP. Okay. Now what is the next step? As we have got already in the first step GDP MP, gross domestic product at the market price, the next step would be GDP MP minus depreciation or consumption of fixed capital is equal to NDP-MP, net domestic product at market price, NDP-MP. GDP-MP minus depreciation or consumption of fixed capital is equal to NDP-MP, net domestic product at market price. Third step, the next step, NDP-MP plus NFIA, net factory income from abroad, is equal to NNP-MP, net domestic product at market price plus net factory income from abroad is equal to NNP-MP, net national product at market price. By the way, here one thing to say, in some of the sums in the entries, they give net factory income to abroad instead of from abroad. Now, if that is given, net factory income to abroad, then instead of adding, you will subtract. That means NDP-MP minus net factory income to abroad is equal to NNP-MP. Now the last step, we come to the last step. NNP-MP minus net indirect taxes is equal to NNPFC or national income. So this is the basic method. I have told about the basic steps in the expenditure method. Now, it may be another modification given. Now, what is that modification? What for the first step? What is the first step here? C plus I plus G plus X minus M is equal to GDP-MP. Because here we have considered that I to be gross domestic capital formation or gross investment expenditure. Gross. Suppose in the question it's given net domestic capital formation. It's given net domestic capital formation. Then directly you can take net domestic capital formation. Even if gross domestic capital formation is given in the question, you don't need that. Take in the net domestic capital formation if it's given. In some questions they may give both gross domestic capital formation and net domestic capital formation. Why shall we take gross domestic capital formation if we are given net domestic capital formation? Because right in the first step then we can take private final consumption expenditure plus net domestic capital formation plus government final consumption expenditure plus net exports is equal to NDP-MP. Right in the beginning, right in the first step, we get NDP-MP. So, in the basic method or the basic steps which I said, as a modification of that, if in the entries of the data, if it's given net domestic capital formation, so we will take net domestic capital formation and then we'll get NDP-MP. So the first step NDP-MP, and then the next step will be NDP-MP plus NFIA is equal to NNP-MP, and the last step NNP-MP minus net indirect taxes is equal to NNPFC or national income. Okay, so these are the steps involved in expenditure method. So I have discussed all the three methods. Now I will go into the precautions of the expenditure method. I'll go into the precautions. But before that, see whether it's income method given in the question or expenditure method or value added method. Suppose the question is find out NDPFC, find out domestic factory income, find out GNPMP, find out GDPFC. If they do not give you to find out, do not ask you to find out national income, then no problem. Step after step you have learned. Then following which steps, adopting which steps, you can get that desired concept. You will be able to understand that. If you learn these steps, step after step, split it into steps, then it's easy for you to determine, to detect that after which step I can get that desired concept, which is the asked question. Now I come to the precautions of expenditure method. Firstly, all final goods and services should be included. Only the final goods and services, not the intermediate goods. The values of the intermediate goods should not be taken into consideration, should not be included. Now, regarding this, I would explain something which is also very important, and this question came in the past in IAS exam. If suppose in the calculation of national income, the value of the final good is taken, and also the value of the intermediate goods used to make that final product, the value of the intermediate goods used, that is also taken into consideration, that is also taken, then that leads to an error, and this error is called error of double counting. Please do remember this, the error of double counting. Why double counting? The value of the intermediate good is taken twice, once as an involved part, an involved component in the final price of the final good, and also if that is taken directly in the calculation of national income, then its direct involvement, its direct estimation is done. So we are taking that twice. For example, it will be easy for you if I give an example. Suppose Maruti Suzuki company is selling a car at 6 lakhs. For example, 6 lakhs. I'm not sure what should be the price. 6 lakhs is the price of the final output, that is the car. Now, in the car, tires are used. Suppose tires are used which are bought by Maruti Suzuki company from MRF Tires company. Then the intermediate goods value, suppose the tires value is rupees 80,000. Then while calculating national income, the tires values the value of the tires should not be taken into consideration, should not be taken into account, because if the value of the tires which came from the MRF Tires company are taken into consideration, taken into account in the calculation of national income, then when the 6 lakhs value of the car is taken into account, in that 6 lakhs 80,000 is included. Then aren't we doing a mistake? We are doing a mistake, we are committing an error, because that 80,000 is taken twice. That is the error of double counting. Now it can be a question, what is the error of double counting? What does it lead to? Now, if this error is committed, the error of double counting is committed, what does it lead to? It leads to overestimation of the national income figure. Then we get a figure of the national income which is over and above, which is more, it is something more than the actual value of the national income. Okay. How can this error of double counting be avoided? The error of double counting can be avoided in a very simple way, only taking into consideration the values of the final goods and services. Right? Next, all expenditures on second-hand goods, all expenditure on second-hand goods are to be excluded, not taken into account. Second-hand goods, again, those are not contributing anything to the current flow of goods and services. These are reflecting just the transfer of ownership. Next, expenditure on financial assets like shares and bonds is excluded. Again, similar reason, because it reflects only transfer of ownership. Now, government expenditure on transfer payments is not included, it is excluded. Transfer payments like pension, scholarship, unemployment allowance, like these. Now, these are the precautions of the expenditure method. Students, I have discussed the 3 methods, the steps in the 3 methods, and then the precautions for each one also. Please remember these steps, learn by heart the steps, learn by heart with proper understanding. Because it's damn important, it's so important, because numerical sum you have to do. If you can solve that numerical sum, either 4 marks or 6 marks you are going to get, for sure. 4 marks or 6 marks. Then, why to leave that? Don't think, please don't think that it is difficult. It is not at all difficult. It's very, very easy if you can remember the steps, and all the steps you should remember in a proper way. The modifications, everything. That's it. Thank you.